What is up, everybody? Crypto Noah back with another video. Happy New Year. In this video, I'm going to show you my exact, simple, step-by-step process on how you can turn a $10,000 investment into $57,000 investing / yield farming in Polygon. So before I get started, as always, I have to say this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like I always say, do your own research, but use this channel as a starting point. So like I said, guys, I'm gonna show you my step-by-step process to turn 10K into 57K investing into Polygon. And if you wanna earn more, that'll be what the yield farming strategy is for at the end. We're gonna go through what problem Polygon is solving with optimistic and ZK rollups and helping Ethereum scale. We're gonna go through their partnerships. We're gonna go through their tokenomics. And like I said, I'm gonna show you my take profit strategy and my exact yield farming strategy at the end. All right, before we get into the content, actually, I gotta let y'all know, I'm wearing my Polygon t-shirt. I got it ETH Denver. This is actually my first time wearing this shirt, and I got it last year. So, yeah, let's get into it, guys. So I wanna first start off talking about creating a structure around your investments. This is my third video like this. Like, people have been telling me it's really been helping them, because you know, the reality is a lot of us think we're geniuses. A lot of us think we can time the top, but it's just not. I'm not gonna say it's not possible. It's not sustainable. You can get lucky, but you know, eventually luck runs out. So you wanna create a sustainable model. So even more so than conducting fundamental analysis and determining what asset is good to buy, you wanna create a structure around your investments. Some kind of take profit strategy before you get in, knowing when you're gonna get out before you get in. That can either be how I'm gonna show you on this video in terms of like, okay, once it hits this price, I'm gonna take it out. Or it can be a time-based take profit strategy and say, hey, I'm gonna hold this for 5 years and have a window to where within that 5 years, whether if it's between the price of 100 and 200, whatever the asset is, just give you an example, I'm gonna sell it whenever it's in my window. So you can also combine the two. But it's really important to have some kind of structure around your investment so that you can optimize your profits and you don't have to, worry about your emotions coming into play and affecting your investment strategy. Like, people say that you don't want to use emotions when you invest. You don't want to use emotions once the market mania sets in. You want to use your emotions when you're coming up with your take profit strategy. I always tell people, as a general rule, there's two types of investors. Investors who like larger amounts of profit less frequently, and investors who like smaller amounts of profit more frequently. And the right strategy for you is the strategy that aligns with your personality. There are multiple ways to skin a cat. Perfect example, you have Warren Buffett and James Simons. Warren Buffett got rich buying, a few companies, being not diversified at all. He's famous for saying diversification is insurance for idiots. He believes in only buying projects that he's extremely convicted on. And he's famous for holding like between 1 and 5 positions at any point in time. Obviously now he has a holding company, so he holds more. But how he got his wealth, that's what he did. And he always preaches against, like, don't take small amounts of profit, don't try to trade, don't try to do this. Whereas if you look at James Simons, the things that Warren Buffett will never do is the exact things that James Simons did and became a billionaire as well. He pretty much helped spearhead the whole quantitative trading revolution. You can read his book, Man Who Solved the Markets. I read it. You're not going to learn any secrets, but it's a good story nonetheless. But people still don't know what his strategies is, but they know it's around quant trading, which is, algorithmic trading. So they're taking small amounts of profit once their parameters are reached. So I'm saying all that to say, when you're coming up with your take profit strategy, your emotions is going to tell you what kind of investor you are. If you're more impulsive, you're probably like more of a trader who likes smaller amounts of profits more frequently. If you're more patient, you're probably more of a value investor. And that's the kind of investor I am. But you can also combine those as well. And that's what we do with yield farming and trading. You can use yield farming to generate passive income, small amounts of profit frequently. And you can take those rewards and send them to another wallet and use them and throw them to your long-term bag and wait for your long-term price levels to reach. So that way you're hitting both. So as you're going through your take profit strategies and you're saying to yourself, do I want to wait till it 3x's? Do I want to wait till it 5x's? Do I want to wait till it just goes up 50%? That's when you want to use your emotions, when you're coming up with your plan. You don't want to wait till the market's going up and down, because your emotions are going to be like, bro, just wait. It's probably going to go up a little more. Just wait it out. And that's how you lose. It's happened to me. It's happened to the best of us. So I'm making this video so that once this next bull market comes, we can maximize our profits and create a duplicatable system. So if you're interested in that kind of thing, here at Know It Alls, we're building a community where we show people how to do all of these things, conduct fundamental and technical analysis, make sure you know how to operate securely so you don't get hacked. We offer not just courses, but as well as personalized video coaching as well. So you hop in on calls. You'll get our buy and our sell calls, the same assets that I'm buying within my hedge fund to generate returns for my investors. I'll be sharing with the group. So if that interests you, click the link in the description, book a free strategy session with one of our team members. We're gonna hop on the call, get to know you a little bit, see where you're at on your journey, ask you a few questions, ultimately just to see if we can help you and see if our program is a good fit for you. And if it's not, we're happy to point you in the right direction. And like I said, answer any questions you may have about investing, yield farming, etc., etc. So now, without further ado, let's get into the content. So before I start off with what solution Polygon is offering, let's talk about the problem. And I talked about this problem in my video on how to turn 10K into over 100K investing into Arbitrum and 10K into 134K investing into Optimism. So watch both of those videos if you want a more in-depth description, but I'm going to briefly touch on it here. So Ethereum, along with pretty much every other blockchain, has a problem called the blockchain trilemma. You have scalability, which is transactions per second, speed, and decentralization. Each blockchain is optimized for two, but they're trying to optimize for all three. So there are three parts to each blockchain. You have a consensus layer that says what's true. On Bitcoin, that's proof of work. On ETH, that's proof of stake. You have a data layer, which is storage, and that's why you hear people talking about shards, which are like parallel blockchains that follow the actual blockchain, so it's able to keep track of the memory. And then you have execution, which is your computational finality, when transactions are actually processed. And that's what layer 2s are being built to help with. Right now, you have all three of those components happening on the mainnet. Each blockchain is in the business of selling blocks. So the more activity and data you have going into each block, the more expensive it's going to be for people trying to do a transaction, whether that's buying and selling NFTs, doing swaps on decentralized exchanges, using some kind of metaverse, like whatever the transaction is, they're all competing to get inside of the next block. And if you have one plane going from San Francisco to New York and you have more people than there are seats, you're going to have more people bidding on a scarce good, and it's going to make the price go up. And that's exactly what happens in every bull market. You have transactions increasing and you have gas fees going through the roof because you have more people bidding on, a smaller amount of block space. So layer 2s are designed to have the computational finality happen on the layer 2, and then they roll them up. That's why you hear about what we're going to talk about here in a bit, ZK rollups and optimistic rollups. They have a different way of coming to the same conclusion, which is rolling up the transactions. And not only do they roll them up, but they compress them so they can make them smaller. Just like when you get an email in a compressed folder, it's a small packet of data, but then when you decompress it, you get access to all the data and you can save it on your computer. It's the same thing with the blockchain. It rolls it up, it compresses it, it submits it to the layer 1, in this case Ethereum, so they can still have the security from the consensus mechanism, and then the transaction gets processed that way. Another analogy is when you go to a bar. Imagine if you went to a bar and every time you bought a drink, you have to swipe your card. The line would be out the roof. The bar wouldn't be as fun to hang out at. You wouldn't be able to talk to people as much. So what they do is they have you open a tab. So you give them your card once, you get your drinks on there, your food, and when you're done, you pay for everything at once. It rolls up all those transactions and you pay for it at once. So that way there is no line. This is the same exact thing that they're doing with these blockchains. And by solving this problem, it's going to help increase the transactions per second. Right now, Visa's at 60,000. Last time I checked, Ethereum's at like 14 transactions per second. They're trying to raise that so that we can onboard the next few billion into crypto, because right now it's just not practical. People aren't going to pay these high gas fees. Not only that, Ethereum is set up to where you know the range of the fee you're going to pay. So like, let's say you're doing a transaction and it tells you you're going to pay between $40 and $80, but you won't know until after the transaction's already processed. Imagine you went into a convenience store to pay for something on your card and the merchant tells you, yeah, your fee's going to be between 20 and 60 bucks, but you won't know until you swipe the card and the transaction's already processed. You'd be like, hell no, bro. Tell me what the fee is now. So we're in the dial-up stages of the blockchain, and we still have a ways to go until things are ready for mass adoption. not just evangelists like you and I. So again, these layer 2s are going to help reduce fees, speed up transactions, and just overall scalability and a better user interface. Okay, so there are two types of rollups. There are optimistic rollups, and then there are ZK rollups. So optimistic rollups verifies the transaction later, and that's why they're called optimistic, because they're optimistic that the transaction is legitimate, and then you have a challenge day period. So unless the transaction is disputed through the challenge period, each transaction has a few days. I think it's 7 to 14 days or something like that. And this is why when you use the native optimism bridge, it takes forever for your assets to get across the bridge because of that challenge period. However, ZK rollups, aka zero knowledge proofs, goes about it in a different way. They're able to tell you if the transaction is verified or legitimate immediately. So a good example to explain ZK rollups is Where's Waldo. So if you think of Where's Waldo, like think of a giant picture and you have like Waldo somewhere. Where ZK rollup is able to circle a picture and they are able to show you like, hey, we know where Waldo is, but they're not showing you where it is, and they're not showing you how they figured out where it is. But nonetheless, it's still showing you where it is. And I feel like more protocols are gonna adopt ZK rollups, and I feel like they're gonna be the thing in the future, just because like all these companies and financial institutions that are coming on chain, they're not gonna want all their transactions and information public, because the company's biggest liability is their customer data, and that's what will be public pretty much, and the company's business data, which will also be public. So I think ZK rollups is a more practical solution, especially for enterprise users, which are going to be the main users. You're talking about DeFi, NFTs, like real world assets, all of those things. I think zero knowledge proofs has a better chance at going mainstream than optimistic rollups. However, there are trade-offs. ZK rollups are newer and they're less battle tested, and they're more computationally strenuous. While optimistic rollups take a longer time to verify, but they're computationally less complex, resulting in layer 2 nodes having more minimal hardware requirements. Ethereum virtual machine or EVM compatibility is also higher on optimistic rollups versus ZK rollups, and that's probably why Vitalik prefers optimistic rollups over ZK rollups. But I do think that will change in the future. As things get easier, the prices is going to go down. Like right now, optimistic rollups are a little more expensive. Like I said, ZK rollups are newer, so I think we just need to give them time to be able to, work out the kinks. Okay, so now that we've went through that, you might be wondering, okay, Polygon is a layer 2 solution. Are they using optimistic rollups? Are they using ZK rollups? The cool thing about Polygon is that they're doing both. So originally, they were an optimistic rollup scaling solution, but they recently released their Polygon ZK EVM, and I think they realized that a lot of protocols are going to go to ZK rollups as well. You even have optimistic rollups developing ZK rollups, like within their framework. That says a lot. Now, like I said, Polygon's doing both, and I think they put like $1 billion towards ZK development. So let's look at some stats here. So here we are on polygon.technology/ZK EVM. So if you want, you can go to the documentation and read all that. But I'm just here to give you guys the high level. It talks about security, EVM equivalence, high performance, low costs. Like I said, they're aiming to help Ethereum scale. So you have some ZK EVM stats. So it looks like it's showing. I'm not really sure what this is showing. I'm not sure if it's showing that because of ZK EVM, the gas price on Polygon or on ETH is dropping. I'm not even gonna lie and act like I know. But this I do know. These are wallets for the Polygon ZK EVM. So since they released it in March of last year, that's crazy. Last year was 2023. Happy New Year again. You can just see this exponential growth. And now they're up to 488,000 wallets. You have smart contracts growing. This is a good thing because it shows that developers are building on Polygon ZK EVM. If there aren't developers building, there aren't going to be users using. And if there aren't users using, there aren't any fees. If there aren't fees, the doors have to close to this business. As a general rule, obviously Polygon has a lot of other things going for them. And then you have the total value locked. So there was a crazy surge at first. It kind of dropped off. And now we're hovering at around a little over $21 million. And then this is a layer 1 gas price. So, okay, maybe this is the gas for the Polygon ZK EVM. So gas has been going up, and that signals that people have been using it. So now, let's just start getting into Matic. We know they're a layer 2. Let's start looking at some stats. So here we are at DeFi Llama, and if you scroll down, you can see Polygon is number 7 in terms of TVL. They have 504 protocols built on Polygon. You can see in the past month, they've had an increase of 8%. increasing 5% in the past 7 days. And you can see that they have $910 million in total value locked, so almost $1 billion. All right. So this looks pretty strong. They're in the top 10. They've been higher, they've been lower. If we click on Polygon, you can see all of the protocols built on top of it. And if we look at this, you can see that it's kind of been like flatlining. And there isn't a sign to show that it's starting to go up yet. And this is a reason why it's a good investment. A lot of times when there's something called a protocol market cap to TVL ratio, right now the total value locked is significantly lower than the market cap of Polygon, which is in the billions. So, and you can see it's not ticking up yet, but I just showed you the stats on the ZK EVM and just Polygon as a whole. Like, people are building more on it. You have users using it more and more, and I think in the bull market that's going to pick up. So this allows you to get ahead of the trend. So this is a strong case for a good investment, because we saw what they did in the last bull market. They have way more partnerships, which we're going to go through, and just way more. They've been shipping. They've been shipping actual products. So I think this is going to exceed all-time highs in the next bull market. So this is a chance to get ahead of the trend. All right, now that we looked at that stuff, let's look at their partnerships. And before we do, I just want to discuss the importance of this. Most bull runs in any investment class are sparked through a narrative. That goes for the investment class as well as individual assets. You see what happens when China would announce, oh, they're banning Bitcoin. Bitcoin would drop. Like, any little piece of news can make the market go up or down. So the more partnerships a protocol has or a project has, that's a good narrative. If something good happens with any of those partnerships that they're partnered with, it can be attached to Polygon. Like, one of their partnerships is Nike. Let's say Nike signs some new star athlete or something or whatever. People will look at that and be like, oh, they're attached with Polygon. And a lot of times it may not even be tied together. But just because people think it's tied together, markets are all people. Sometimes just because I know or have a feeling that people will buy something because of some narrative, even if it has nothing to do with it, it could be a good reason to jump into the investment just to experience some price gain. So let's go through these partnerships and talk about the significance of them. All right, so here we are on blockchaincouncil.org, and this is the top 10 partnerships for Polygon. And this isn't all of them. This is just the top ones. So as you can see here, they have a partnership with Nike. They have all the details surrounding the partnership. With Starbucks, this is has to do with NFTs, which is really cool. MasterCard. MasterCard is one of the largest card companies. And this has more of a parallel because Polygon is almost like a payment platform as well. People go on there to do transactions. Adobe, Disney, Meta, aka Facebook, Adidas, Mercedes, Reddit, and Google Cloud. Guys, these are some huge partnerships. Some of these are multi-billion-dollar companies like Google and Meta. And the brand power of all these is strong as well. Starbucks is a strong brand. Nike is one of my favorite brands of all time. It's up there with Apple. Disney, not going to say anything about that. And then obviously Mercedes is a top luxury brand. So it's like, these aren't just small mom and pop partnership. So I expect this to have a significant effect when we go into the bull market. Like, you look at Arbitrum and Optimism, not saying it's out of the cards, but they're not partnering with these same companies. So it says a lot about Polygon's technology shit and their business development team. All right, so now that we went to the partnerships, let's go through the tokenomics and see, if this is a good investment. Because a lot of times in crypto, it's not all about if the project is good. You want to make sure the tokenomics are favorable so that you want to make sure there isn't a large supply about to be dumped on the market, some investors or VCs about to sell. Like, you want to know all the details around the tokenomics so that you can know if and when is a good time for you to get in and a good time for you to get out. Okay, so here we are on CoinGecko. You can see they have a market cap of 9.3 billion and they have a fully diluted valuation of 10 billion. So that means a little less than 1 billion that still has to come onto the market. That's not bad. I've seen way less favorable market cap to fully diluted valuation ratios. So we need to figure out, when are these tokens coming onto the market? So let's look at the allocation. You can see that Binance had got 19% of the Matic tokens. Private investors got 3%. The team got 16. Advisors got 4, which is like also the team in my opinion. The foundation got 21. The ecosystem got 23. And they saved 12% for staking rewards. All right, so how is this remaining a little less than 1 billion coming onto the market? So you can see the supply schedule. Most of the Matic is on the market already. This is a good thing. I don't know. You have to go on the block explorer to track their wallets to see like how much the team is still holding, but most of them are unlocked. And you can see that the next unlock is going to come January 6th of 2024. And it's not that significant. So if you're looking to buy Matic, it might be a good time to wait till after the 6th to do it. Or, depending on how the charts look, it could be a shorting opportunity. I'm not short Matic right now, but I'm just saying it could be. You never know what can happen. So now that we went over the tokenomics and we know when the coins are going to get unlocked and how many, let's go over my take profit strategy so you can see how I'm going to turn my $10,000 into at least $57,000. I'm not going to say at least. I'm going to say a high chance to turn it to $57,000. So I'm going to give you a reason as to why I think Matic is going to hit the price that I think it's going to hit, as well as my structure for getting out. And it's just like, even if my price target isn't hit, at least I have it set up to where I'm taking profits out on the way up, because you never know what can happen. We are still in a high interest rate environment. I do still think we're going to see a recession this quarter, next quarter, latest. So it's a lot of balls in the air. So you want to make sure you develop your plan and stick to it. Okay, so basically I think Matic is going to 6.5x. So that would bring Matic's market cap to $75 billion. And like I said, you can't time the top. So just because it's going to 6.5x don't mean you're going to get the whole 6.5x, because it could 4x, it could 3x, it could 5x. You never know. Why do I think Matic has a chance to reach a $75 billion market cap? Well, to determine that, let's see what the other layer ones and layer twos did in the last bull market. And the reason why I look at the layer ones is because I feel like in this next bull market and just in the future period, I feel like more protocols and applications are going to be built on the layer 2 versus the layer 1. And the reason why is because, like I said in the beginning of the video, layer 2s are designed to help the layer 1s scale. And the computational finality is going to happen on those layer 2s. So it only makes sense that that's where the applications are built. So layer 2s are almost going to be like the layer 1s. Another thing, layer 2s haven't really had their time in the sun yet. Like, this is the first bull market where we have like layer 2s like actually built out, applications on them, ready to use. Yeah, Matic was around last bull market, which is even better for us, but it didn't have competition and it wasn't as built out as it is now. Another reason why I think Matic can hit a $75 billion market cap is because I believe that this is going to be the bull market when institutions get in. More hedge funds, more pension funds, more ETFs, more products around crypto. Like, you have the largest companies, the largest financial institutions either buying or building out crypto products. So I think it's going to raise the valuations of everything. So let's start to go through this. So we saw Polkadot hit a $56 billion market cap in the last bull market. We saw Cardano hit $94 billion, Solana $75 billion, Phantom $8 billion, AVAX $30 billion, Atom $12 billion, Near $12 billion, ETH $560 billion, Tezos $7 billion. If we look at layer 2's last bull market, Matic hit a $19 billion market cap. Scale hit 1 billion, Loopring hit 1.4 billion, Midas 673 million, Mantle hit 1.7 billion, and Immutable hit 1.7 billion. So I think that given that they hit 19 billion last time, I don't think 75 billion is out of the cards. I think they can honestly hit 100 billion, but I'm just trying to be conservative. They're battle tested. They showed that they can still ship and stick around. And, with all the new partnerships that they have this bull market, who knows what's happening with all those partnerships as those things start to get announced, because I'm pretty sure they're not going to announce them in the bear market, or maybe not all of them are the best ones. So once partnership initiative starts to get announced, the bull market comes in, you have institutions getting in. I think 75 to 120 billion is not out of the cards at all. So now I'm going to show you my profit taking strategy to take advantage of whatever happens. All right, here we go. And I know I wrote all this stuff down. It's just easier for me. I'm old school. So you guys may be thinking like, man, I thought it was going to be more complicated. Like, if it's the greatest truths and the greatest things in life can be simplified. Even when the DNA molecule helix was discovered, this is one of the most complex discoveries in history. The speech for it was like 5 or 10 minutes. So no matter what it is, it can be simplified. So let's go through this. So right now, the current price is $1.01. All right. The current market cap is $9,334,964,794. Estimated market cap is $75 billion. Like I said, this is a 6.5x, give or take. So right now, let's say you have 10K invested. My first take profit strategy is going to be when it does a 3x. So the price will go from $1.01 to $3.03. This is going to take the market cap from a $9.3 billion market cap to a $28 billion market cap. And my $10,000 is now going to be worth $30,000. So now I'm taking out 12K in profit as soon as that happens. Why 12K? Well, when I'm taking profits, my whole goal is to be playing with house money as soon as possible. I want to get my principal back so I'm in a risk-free trade so that whatever happens, at least I made money. So I want to take my principal out plus 20%. All right, so I just made 20% profit. So now I have $18,000 left. So my second take profit is going to be when it increases another 2.5x or 250%. That's going to bring the price from $3.03 to $7.57. And it's also going to bring the market cap from a $28 billion market cap to a $70 billion market cap. So now my $18,000 is going to be worth $45,000. So at that point, I'm taking out 25,000. Remember, I think my conservative target is 75 billion. And when you're taking profits, it's sometimes a good idea to take it a little bit below because a lot of traders are looking at even numbers. So at that point, I'm taking out 25K. All right. So now pretty much my market cap level is hit. I have $37,000 in profits and I have $20,000 left. 37,000 plus 20,000 is 57,000. You just turned 10K into 57,000. So now you're probably wondering like, okay, what if it keeps going up? Like, what's the plan then? You still got 20K. Should I sell it? Should I keep it? What should I do? At that point, I'm going to implement a 20% reoccurring take profit every 25% increase in the price because I feel like we'll be getting close to the top. Hey, maybe market sentiment will still be like crazy. Maybe I'll adjust that. But it won't be anything over like 50 to 75%. So as increase 50%, I might take out 50% of profits. Like whatever the increase is, that's the percentage I'm taking off. Okay, so now that we went over the take profit strategy, let's go over my yield farming strategy so I can show you how you can accumulate as much Polygon passively as you can so that you can have more to sell when the price does inevitably go up. All right, guys, so here we are on TradingView, and like I always say, like when you have your take profit levels, you want to put it on your chart so that way you can have a better visual of it. You can set up limit orders or you can set up yield farming strategies like I do or a combination of both. All right. So this is the Matic USDC pair. So one yield farming strategy that I would entertain to you guys to look at. And like I always say, the yield farming done best is a long-term strategy. And sometimes long-term can be 6 months. Sometimes it can be a year. It doesn't have to be a multi-year time frame. So let's say you got in this yield farming strategy a year ago and this was your range from 50 cents to $1.18. And you have to keep in mind, if you got in right here at 50, let's say you got in at 50.50, you're relatively at the same exact spot. So if you were to got out right now and you were in this for a year, you would have experienced permanent loss going up, going down, but you would have broke back even and you'd have been able to keep your fees. So I like to use builder metrics. You go on here, you click Polygon, you put your ranges and you pick the days. I already preset it so that I can keep this video as short as I can. So the ranges on the chart, all you do is copy them. So you have 0.05090, 118.55. You literally come up here, you put it into your ranges. I already have them here. And off a $1,000 deposit in 1 year, you could have made a free $373.74. That's with $1,000. So if you got 10K and you got 20K, you just multiply that from what you would have did or what you could have did. And that's free money, guys. Free money. And you're getting paid in Matic and USDC. You can take those fees and use it to buy more Matic. You can turn it into USDC and just leave it as dry powder to sit on the sidelines. You can do whatever you want to do with it. And we teach you how to do these things like a pro. Like we teach you how to implement the same market making strategies that financial institutions do when they're providing liquidity for traditional exchanges in the traditional financial world. And that's what I always say. People who make the most money in recessions are market makers because they make money no matter where the wind blows. And we show you guys how to do that like a professional. Another thing, when you're looking at your investment structure, you always want to have risk management at play. It's like you want to be able to build a case for why you should hold Matic over ETH. Because if you're better off holding ETH, I think ETH is going to 3 to 5x in the next bull market. Why I'm going to hold some altcoin if I don't think it's going to outperform it? Well, I do think Matic is going to outperform ETH in the next bull market. Right now, ETH has a multi-billion-dollar market cap. Matic's only $9 billion or so. So in order to double your money with Matic, there only has to be a $10 billion investment versus an ETH a multi-hundred-billion-dollar investment, which isn't out of the cards, but it's just more money. The more an asset goes up, the higher the market cap gets, the more money there needs to be invested for you to make more money. All right. And that's the cool thing about crypto. You get to find asymmetric opportunities where there's little downside and high upside. So I like to look at ratios. This is Polygon versus ETH. Every time the chart's going up, that means Polygon is outperforming ETH. When it's going down, ETH is outperforming Polygon. So as you can see, pretty much since the past year, we've been under our 62 EMA and under the 200-day. But as you can see here, every time we got down to this level, Matic went on a run against ETH. So this is a good strategy to employ if you want to take profits in Ethereum. You want to sell off your Matic to take profits in ETH as it's going up. So you can set up this range here between this green box. You can have one go from the bottom here to here, another one from the bottom one to here. So that way, as it's going through your take profit levels, you can use a platform like Aperture, which I've made videos on, that says, hey, as soon as this price or this level is hit, get me out of the pool with my fees. And now you just literally got paid passive income to take profits. All right. So this is a pool I'm in. So let's say, you copy these ranges here and here. And let's say you were in this pool just for like the last 30 days. You go back to builder metrics I've already populated, or let's say the last 90 days. You could have been making 58% APR in ETH and Matic from $1,000 deposit. So you could have made $47.75 per month in free money. Guys, that's not bad at all. All right. So again, you can extrapolate that based on like what your holdings are. And past results doesn't indicate future results, but you want to, and we teach you how to do this, you want to get good at developing a strong thesis for where you think the market's going to go and why. And you want to have a plan in place for just in case your thesis is invalidated. And you also need to determine what would invalidate your thesis. So that way you have a plan set up no matter what happens within the entire market. So with that, I'd like to conclude this video. I hope it was a blessing to you. If you got value, I ask that you consider subscribing, not just to Crypto Noah here, but also to Know It Owls. We break down, give more of a macro perspective, macro financial perspective, and we cover other protocols that isn't just, solely based on yield farming. So like I said, subscribe to the channels, drop a comment, offer some constructive criticism. I know I need to get a new mic. It's in the mail right now. I'm sorry if the audio is bad. Just make sure it's turned up on your device as well as on YouTube. Share this with a friend. Guys, I really do welcome constructive criticism. Let me know what protocol you want me to cover next. And like I said, Happy New Year. I hope 2024 is extremely prosperous and fruitful for all of you here. I love every single one of you watching, and I will see you guys tomorrow in the next video. Take care.